Hi guys, my name is Rayo and I'll be talking on process costing. First of all, what's process costing? Process costing is a method used in a situation where production follows a series of sequential processes which use the same type of product at the end of the processing activity. So, process costing is like costing each processes down to the end of the finished product. That's costing each of the process. Maybe, for example, you want to make can be, for example. Now, in process costing, you're going to be costing each process from the killing of the cattle to the cutting of the cattle to the buying of the cans and all that. So, process costing has to do with calculating each cost at each process. It's a form of operation costing used to produce standardized homogeneous goods or products and is often employed in industries such as chemicals, textiles, steel, rubber, sugar, etc., as well as assembly type of industries. The This is a representation of process costing, a diagrammatical representation of process costing. Now, process costing has to do with the input, that's the direct material, direct labor, and manufacturing overhead. Now, those are the material, and those are the inputs required for the manufacturing of a product, for example. Now, then you see the department A, department B, department C. Those are the different processes involved down to making the finished goods. So you can see that from the work in progress inventory department A, let's assume that's like the first process, down to the second process, down to the third process, then down to the finished goods inventory, and then to the cost of goods sold. That's to the selling of the product. According to CIMA London definition, process costing is a form of operation costing which applies where standardized goods are produced. Thus, it allows businesses to ascertain the cost per unit by dividing the cost of each process by the output of that process. In this costing method, costs are accumulated for each stage of production or processes. Now, these are key points to note under process costing. The cost per unit of product is ascertained at each stage of production by dividing the cost of each process by the normal output of that process. It is also assumed that the average cost is equal to the cost per unit. Hence, cost per unit is equal to cost of production divided by the number of units, or total cost of each product divided by the normal units. Here are some few features of process costing. Continuous production. It has to do with saying that that's when it comes to process costing, it's continuous and it's uniform. Number two, homogeneous products. That's to say that the products are standardized and identical. In process costing, you're not trying to manufacture different products. You are trying to manufacture just one product. That's you want to manufacture cake. So you want to bake a cake, or you want to manufacture phones. So process costing just has to do with costing each process as regard the production of that phone, or as regards to the baking of that cake. Feature number three, standardized process. The processes are consistent and following a set of pattern. Feature four, sequential process. Output from one process become the input for the next process. For example, in a baking industry where one person is responsible for baking the cake, another person is responsible for decorating the cake, and another person is responsible for delivering the cake, the output of the first person that's baking the cake serves as an input for the next person who is decorating the cake. And then the person decorating the cake serves as an input for the person delivering the cake. Advantages of process costing: we have cost collection. That is, say costs are collected process-wise, providing clarity. That is to say that at each process, costs are collected, thereby not making everything to be. Limitations of process costing. Costs are collected process-wise, and this might not be efficient for all production types. That is to say, process costing is not applicable in all production types. Number two, indirect cost accumulation. Accumulating both direct and indirect costs in each process can be complex. Number three, semi-finished goods. Semi-finished goods stock is expressed in equivalent units, which may require more complex calculations. Okay, so accounting procedures for process costing. Items on the debit side of process account. To note, items on the debit side of process accounts includes those items that are going into the process. And this item include cost of materials used in that process, cost of labor incurred in that process, direct expenses incurred in that process, overhead charged to that process, cost of ratification of normal defective, and cost of abnormal gain if that arises in the process. While items on the credit side of process accounts includes those items that are going out of the business, and these are scrap value of normal loss, cost of abnormal loss. Okay, to note, the cost of the output of the process is transferred to the next process. The cost of each process is thus made up to cost brought forward from the previous process and net cost of material, labor, and overhead added to that process after reducing the sales value of scrap. The net cost of the finished process is transferred to the finished goods account. The net cost of the finished process is transferred to the finished goods account. The net cost is divided by the number of units produced to determine the average cost per unit in that process. Now, all this will be better explained in the question. That's when we get to the question to solve. Okay, so this is the format for a process costing. And as you can see, as we've said, on the debit side are items going into the process. That's basic material, direct expenses, production overheads, cost of ratification, of normal defects, abnormal gains. While items on the debit side are items going out of the process. That's normal loss, abnormal loss, that's transferred to the next process 2, and the finished stock. That's process 1, stock account. Okay, so process losses. In many processes, some losses are inevitable. Certain production techniques are of such a nature that some loss is inherent to the production. That is to say, some loss are parts of the production process. Wastages of material and evaporation of material are unavoidable in some processes. But sometimes, losses also occur due to negligence of the laborer, poor quality of raw materials, poor technology, etc. These are normally called avoidable losses. Basically, process losses are classified into 2 categories. We have the normal loss, which is value at scrap, and we have the abnormal loss, which is value at cost price. Now, the normal loss, these are unavoidable losses that occur due to the inherent nature of the material and production processes under normal condition. So normal loss are losses that you can't avoid and that are part of the production process. It is normally estimated based on past experience in the industry. It may be in the form of normal wastage, normal scrap, normal spoilage, and normal defectiveness, and can occur at any time in the process. Number of units of normal loss is equal to input times expected percentage of normal loss. The cost of normal loss is a process. If the normal loss unit can be sold as scrap, then the sale value is credited to the process account. If rectification is required before the sale of the normal loss, then debit that cost in the process account. After adjusting the normal loss, the cost per unit is calculated with the help of the following formula. Cost of goods per unit equals the total debit amount in the process account minus the normal loss scrap divided by the total units input in process account minus the normal loss. Now to the abnormal loss. Any loss caused by unexpected abnormal conditions such as plant breakdown, substandard materials, carelessness, accidents, etc. Such losses are in excess of predetermined normal loss. This loss is avoidable. Thus, the abnormal loss arrives when actual losses are more than the expected losses. This is to say abnormal loss can be avoidable and that they're not meant to happen under normal setting condition, but then they happened. And then they are always more than the normal loss set by the organization or the business. Abnormal loss is equal to actual loss minus normal loss. The value of abnormal loss is done with the help of the following formula. Total cost increase minus scrap value of normal loss divided by the input unit minus the normal loss unit multiplied by the unit of abnormal loss. Abnormal process loss should not be allowed to affect the cost of production as it is caused by abnormal or unexpected conditions. Such loss represent the cost of material, labor, and overhead charges, called an abnormal loss account. The sales value of the abnormal loss is credited to the abnormal loss account, and the balance is written off to the costing profit and loss account. Okay, so this is the format for the abnormal loss account. On the credit side, we have if the abnormal loss is by cash or by bank. And then on the debit side, we have the process. That's the process accounts for which we identified the abnormal loss. On the credit side, we also have by costing the P&L accounts. So let's talk about the abnormal gain. The margin allowed for normal loss is an estimate. That is on the basis of expectation in process industry in normal condition. The margin allowed for normal loss is an estimate, and slight differences are bound to occur between the actual output of a process and that anticipated. The difference may be positive or negative. If it's negative, it's called abnormal loss, and if it's positive, it's called abnormal gain. If the actual loss is less than the normal loss, then it is called an abnormal gain. The value of the abnormal gain is also the same, or rather similar to the manner of the abnormal loss formula. The formula for the abnormal gain will therefore be total cost increase minus scrap value of normal loss divided by input units minus normal loss units times unit of abnormal gain. That is to say, the difference between the abnormal loss and the abnormal gain formula is the multiplying the unit of the abnormal gain or loss. The sales value of abnormal gain units are transferred to the normal loss account since they arrived out of the savings of normal loss. The difference is therefore transferred to costing profit and loss account as a real gain. This is the format for the abnormal gain. We have just like the opposite of the abnormal loss. On the credit side, we have the process of which we identify the abnormal gain. On the debit side, we have the normal loss and to costing profit and loss account.